You say with these job numbers that we got today, the Fed's going to keep cutting, even though the Fed shouldn't. And so what should investors anticipate doing in 2025 to take advantage of whatever result is going to come from that?
Yeah, I mean, we're kicking off 2025 with the continuation of that over-easy policy. And today's job numbers were just soft enough to confirm that we're going to get another cut in December, and probably those cuts are going to continue into the first and second quarter of the year. And that's kind of setting us up for a perfect situation for risky assets where you've got cuts coming, so monetary easing, you've got fiscal easing on the horizon, regulatory relief on the horizon from the Trump 2.0 administration, and at the same time, growth is pretty good, right? Employment's hanging in there, continues to power forward, consumption continues to be strong. This is a perfect combination that should support asset prices ahead.
David, do you see it the same way, and do you think the Fed would be wrong to keep cutting with numbers like this?
Well, John, I'm not a big believer in talking about what the Fed should do. I try to tell our clients what I think they're going to do, and I agree they are going to cut. I think the consensus is probably closer to right than wrong. There's going to be a pause at some point, or a slowing or a kind of hawkishness to the language that they can wait a little while. But my belief is generally that the data are going to start to confirm that the neutral rate is actually just where it was before COVID. So we're going to go back and realize that 2017, 18, 19 rate levels, the Trump 1.0 rate levels, are going to be consistent with the Trump 2.0 rate levels. And that's actually a way, way, way out of consensus view. I think most people, even at the Fed, but certainly on the street, and investors I speak to, all seem to have come up with some rationale for raising their neutral rate forecast. And I think we're going to stand out. I'm going to stand out next year and into 2026, really pushing this idea that I don't think that's true. And we'll find out in the data. The data is going to come in, and we'll see how the inflation data work. I think they'll probably surprise to the downside by the end of 25, maybe even the middle of 25, and that'll put some pressure on the Fed. But I really think that's an even more powerful positive for the risk asset story that Bob just outlined. It's an even bigger tailwind. So we agree on direction. I think I'm going to probably have a slightly bigger magnitude because just my rate view is so different.
I do want to dig into that a little bit deeper. But first, Bob, the fact that you have the NASDAQ at a record, S&P, it looks like squeaking out with a record close here. Big tech's been really leading the charge, and we've seen that rotation out of the more cyclical parts of and maybe economically sensitive parts of the market. You have the Russell 2000 down on the week. You have the Dow Industrials down on the week. And actually, the transportation average, the Dow transports have really taken it on the chin. Looks like finishing down more than 4% this week. Why are we seeing that rotation, given the fact that the economy does remain so strong?
Well, I think what we're seeing is a situation where basically a lot of hype right after the Trump election came into the pro-growth stocks. They got a little bit of a bounce and a rally and some short covering. And that's, you see some folks who are taking some profits on those trades through the course of this week. But big picture, if you take a step back, you look over the last 4 weeks, everything's up. And so various folks will talk about how they had a particularly genius idea about Bitcoin or bonds or tech stocks or the Russell 2K. And the reality is the underlying driver of what's going on here across basically all of those assets, it's the same thing. It's over easy monetary and fiscal policy that's ahead. And that's lifting everything. And, day to day, week to week, one thing might be up more than another. But that overall trend is what's driving the market today.